Hey everybody, and welcome to, we're closing in on the end of the unit chapters, and this week we're going to cover chapters 12 and 13. If you recall, we've been in the mode of talking about the capital budgeting process, and chapters 12 and 13 help us bring that to rest. So the work we've been doing up to this point has been just building on that and will help us do what we are going to do in chapters 12 and 13. So taking a look at that, the past couple of weeks we've been talking about we started by talking about the time value of money. Of course, that's a foundational aspect of thinking in longer term. Then we talked about valuation and rates of return, which are kind of the precursors or the thought process where to talk about, how you actually evaluate longer term types of things. We talk about the cost of capital as it applies to that and how we manage a mix. And then we're going to talk about the capital budgeting decision, which is chapter 12, and risk and capital budgeting, how they work together. And that's chapter 13. Now, in chapter 12, I think a lot of students find that interesting, and I'm going to tell you just from my perspective, from a higher level management standpoint, chapter 12 is really kind of key in financial management in terms of making decisions on what the company is actually going to do, how it's going to proceed going down the road. So, chapter 12, I think, is one of the more important chapters in the text. So let's take a look at that. In chapter 12, we're going to talk about how the capital budgeting decision represents a long-term investment decision. So if we have anything that's going to extend beyond the very short term, or let's say a year, which a lot of big decisions within organizations do, they last beyond that. So we have to think about how we actually go about thinking about how to do that. So you should know that cash flow is used rather than earnings to make those types of decisions. And the reasons should become pretty obvious when you read through that. There's lots of different methods here. There's payback methods that are out there. Some organizations use that as just kind of a rough first cut at looking at whether they want to pursue a particular project or not. But they don't really give us the hardcore look at, what does this actually mean to the organization. It's just sort of a filtering mechanism, if you will. So you understand the payback method considers the importance of liquidity, but fails to consider the time value of money in those decisions. And that's why you're going to, if you're involved in these types of decisions, you're going to look at net present value or internal rate of return. Those are two broad types of methods of capital budgeting analysis. And they can have all kinds of variations. I mean, I've worked with a lot of different organizations who call them different things. Slight variations on what you're going to look at here. But the gist of it is the same, in terms of what it's trying to measure and what it's trying to determine. And then you want to know that the discount or cutoff rate is normally the cost of capital, which is something you have to establish with what the organization you're working for thinks that is, and you have to work around that. So capital budgeting is a really important part of finance, and an interesting one. So take a good look at this. This is something that, again, if you get into management and higher up that you move, capital budgeting becomes a pretty important part of it. Let's take a look at chapter 13. Now, chapter 13 talks about risk and capital budgeting and how we incorporate risk, or try to account for risk, if you will, within the capital budgeting process. So you want to know what risk is. It's maybe not what you might think outwardly what it means. In finance, we think of it somewhat differently, and because it's how it's measured, and we're trying to measure it. How do you measure risk? It's not an easy thing to do, right? Recognize that most investors and organizations are risk averse, which makes sense. Nobody really wants to invest in a highly risky or enterprise because, why bother? Why put your dollars at risk when you don't have to? So you need to get something for that, and what that means is that you're going to require much higher rates of return from risky projects. So, from a financial management standpoint, that makes sense. We take a look down the road and we say to ourselves, what's the payback on this thing? If it's kind of not that spectacular, why take the risk? There's got to be better decisions to make. So you can start to see all these things come into play when we start talking about whether we want to change the direction of an organization and start going into other things, or build on the existing things that we're already doing and make big investments in it. So we expect higher rates of return from risky projects, and risk is a way we can actually assess that. They talk about here in the book about simulation models and decision trees and things like that. I can tell you this, with the proliferation of all the data that's out there, that all gets turned into these models, if you will, and it actually inherently makes things less risky because we have more information and better information to make decisions from. So that's definitely the direction that financial decision making is taking, is we're using all this data to help us understand that combined with artificial intelligence helps us make much better decisions. We don't talk a lot about that in the text, but just know that it's out there. Assess, and the final thing we want to learn is to assess the impact of a given investment on the total risk of the firm. And you're going to do that from a financial management standpoint, or just from a general management standpoint. You're going to be doing that on a regular basis, and being able to talk to it. So these chapters 12 and 13 are very interesting chapters, regardless of what part of management you go into an organization, because at some point this is exactly what you're going to be talking about with your with the management team. Okay, so that's chapters 12 and 13. Work through it, do the problems. I think you'll find them really interesting. Again, if you have any questions, don't hesitate to reach out and ask. And it's not too soon to think about this either. I'm going to go back to our schedule real quick here. And this week, our second test, our second unit test, which is test number 3, covering chapters 9 through 13, is coming up a week from Monday this week. So you have to do it by the 21st. And I'll put a little bit of information on it, but it's very similar to the test you just took back there a couple of weeks ago. So you kind of know what to expect. It's got a very similar feel to it. So hopefully that'll help you prepare for that particular test. So again, if there's any questions, please let me know, and I'll be happy to speak with you, or set up a meeting, whatever we need to do to kind of work through that stuff. All right, best of luck to you, and good luck this week.